students. Welcome to the session of non-core, that is descriptive analytics of financial statements. In previous session, we are started with the unit 3. In that subunit 3.1, that is ratio analysis, its meaning and key features and advantages and disadvantages. As you all understood that ratio analysis is what? It's showing the major differentiations or relationship between one number and another number, where which will help our business to understand what is the required data where will be analyzed, and it will be telling us that what is the efficiency of a business in the basis of three major ways. So first one is our profitability, second one is liquidity, and the third one is solvency. Based on these three measures, we can analyze and we can understand that what is our efficiency of our business, right? So let us start with the subunit 3.2 called classification of ratio analysis. So in this classification, there are several classifications, and you can see one by one that how it will be relevant to business, what are its major role in the ratio analysis. Okay, so I'll be sharing my PPT. Please give me a minute. I hope my screen is visible to you all. So this is subunit 3.2, classification of ratio analysis. So this classification of ratio analysis are in the two way, in the nature of accounting statement from when ratios, which the ratios are derived, and the next one is classification from the point of view of a financial management or objective. Okay, so these are the major two major heads where the ratios will be classified. In that first head is classification according to the nature of accounting statement from which the ratios are derived. In this first type is balance sheet ratios. So what do you mean by balance sheet ratios? These ratios deals with the relationship between two items appearing in the balance sheet. Okay, so this ratio is completely dependent on the balance sheet where a company will prepare its balance sheet. Okay, so that it will be it will tells us that what is the relationship between the two major items which are appearing in the balance sheet. So example like current ratio, liquid ratio, and debt equity ratio. So what do you mean by current ratio now? Current ratio is what it will tells us that what is the uh, credit payability. So in which how many time we can pay the credit, what is our credit paying ratio. Okay, and liquid ratio, so in how many time we can convert our cash or convert our assets into a cash. And debt equity ratio will be telling us that what is the leverage rate where we can have the debt and where we can have the equity. Debt is nothing but which is borrowed from the other person for running of our business as a part of capital, and equity is what which is introduced by the partners, or we can say the public or private peoples. Okay, so this is what the balance sheet ratios will be having. Next, profit and loss account ratios. So profit and loss account ratios, this type of ratio shows the relationship between the two items which are profit and loss account itself. So it will be showing about that what is the relationship between the profit and what is the relationship between the loss which are appearing in the profit and loss account in that. So in that it will be going to give us that the gross profit ratio, net operating ratio, and operating ratio, and stock turnover ratio. So in profit and loss account, what we record, we will get the gross profit, and net operating, that how a company is operating and how much it is generating the profit, and operating ratio. So by this we can understand that what is our sales, how much is company are earning, and what is the company's efficiency. And next is stock turnover ratio. So how much stock we are available and how much stock is sent out. So based on this, we can understand that what is the available stock turnover. So how we can turn over our stock in a very easily. Okay, next is combined or composite ratios. So combined or composite ratio is what? These ratios shows the relationship between items, one of which is taken from profit and loss account and the other from the balance sheet, where it is a combination of balance sheet and profit and loss account, which will be together involved, and the relationship between them will be analyzed and it will be given to the company. For example, we can say that rate of return on capital employed. So capital employed in the sense how much capital we are using for a business. Okay, so that is what capital employed. So how much the return will be available on that. So what will be the rate of return will be on a capital employed. And next, debtors turnover ratio. So debtors turnover ratio in the sense in how many times we can get back our debtors. So what is the reverting back the debtors. And next, stock turnover ratio. So again, same thing, that what is the stock available with us, how much stock we are used for the year, and how much stock again added to the business, right? So this is what stock turnover ratio. And capital turnover ratio will be telling us that how much capital we are involved in our business, how much capital we are taken again, how much capital is used. So about this capital turnover ratio will be telling us that how much capital is used and what is all that turnover. Okay. Sorry. Next comes classification from the point of view of financial management or the objective. So one of the major important one. So it will be telling us that what is the view of financial management according to the financial management or objective, why we are preparing, why these ratios will be classified. In that, first one will be the liquidity ratio. Okay, so liquidity ratio will be reveal the ability of a company to pay off its short-term obligations. Okay, so liquidity ratio will be telling us that in what manner, in how much the company is having the ability to pay off its short-term obligations. So what is the short-term obligation means here? Short-term obligation is that the debit or the liability which we are having in our business, which has to be paid within a year, within a month, or within certain period of time. So that is what called the short-term obligation. For example, if you are paying, if you are having a short-term obligation in the sense, for example, you will visit a store where you are a regular customer and you will have a will purchase some raw materials. Okay, so you will purchase some raw materials or you purchase some materials which is required for your business. Okay, so that company owner or that the person who is letting you on a credit basis, he will be giving you a credit term of 3 months. Okay, so for that 3 month, you how much ability a company is having ability to pay its liquidity or its obligation, that will be known as a liquidity ratio. Next, capital structure ratio. So what do you mean by capital structure ratio? It will be shows the long-term solvency of a company. So how much time a company can keep in a running. What is the company's durability time? It will shows that what is the company's durability. For example, capital structure ratio will be giving us the hints about that. What is our capital structure? Okay, how our capital structure will be there. For example, as I told, the leverage related. What is the debt and what is the equity? Equity will be what? It is a owner's contribution. Owners will not go until and unless company will completely shut down. Okay, but debtors will or uh, the persons who are let out, who are issued the loans to us, from whom we are borrowed the money as a capital part or as a capital contribution. They will run when our company is starting going for a insolvency or it is going for a shutting down. Okay, when it is in a shutting down, they will try to run out from that company. They will take over there, they'll take back their all the investments, because they're having fear that whether company gone for a loss, then we will be facing a loss. Okay, so which will be telling us that how much term a company can be there. Okay, so this is what capital structure ratio, by understanding, by analyzing the uh, analyzing the data related to the capital structure. Next, turnover ratios. So turnover ratio is what? It measures the efficiency with which various assets are utilized. So turnover ratios will be what? It will be efficiently measuring. It is measuring the efficiency with the which various assets are utilized. So it will shows that what is our efficiency, where we can use our various assets, where our various assets are utilized for the business purpose to get what extent of efficiency. That is called what? The measure the efficiency with which various assets are utilized. Next is profitability ratios. So profitability ratios tells us that the success of a business in terms of profit. So how much a profit is earned by a company, what is its previous profit, what is its current profit, what will be its post coming profit. Okay, so this will be analyzes based on the certain expenses, certain measures, so by which we can understand the profitability ratios of a business, right? So this is about the 3.2 subunit, which will be telling us the complete classification of a business. Thank you. So this is it for the today's session. So I'll be winding up for the day, and thank you for being there. Thank you all.